Hello everyone, good day. I am Jenny Hias and I am a teacher 3 senior high school teacher applicant. And for today, I'm gonna have my demonstration in fundamentals of accountancy and business management. So to start with, we will have an activity, and this is entitled the word hunt. So I know that you are very familiar with this. So I'm going to show you a box. You have to find the words which is related to the accountancy and business management topics. So I will give you 5 minutes to do it, and you have to encircle all of the words that you will find in there. So timer starts now. Okay, let's check your answers. Okay, first answer that we found is sales. Next we have profit. We have loan. Okay, correct. We also have financial statements. Next we have break even. We have income. We also have record. So now that we are done with our introductory activity, I will show you our learning objectives for today. Our first learning objective is to define what is accounting. Second, to identify the different accounts on business transactions under assets, liabilities, and owner's equity. The third objective that we have for today is to exercise the importance of the accounting process or accounting cycle. Then the fourth one is to give importance to the end product of the accounting cycle, which is the financial statements, and how it is important to the different types of users. So when you hear the word accounting, what comes on your mind? Most people says that accounting is all about numbers, calculations. Actually, there is more to it. So when we say accounting, it is considered to be the language of the business. Accounting is the process of recording financial transactions. It involves summarizing, recording, reporting. The accounting process involves summarizing, analyzing, and reporting business transactions to oversight agencies, regulators, and tax collection agencies.
The accounting process. Accounting process starts with the identification. Identification phase includes the selection of economic events or business transactions. The second phase involves the recording process. In the recording, the accountants records business transactions. They classify, sort, and then they summarize by creating financial statements, and those financial statements are to be reported by the end users of the financial statements, or FS. Also, the accountants made analysis and interpretation coming from the financial statements, and that will be used by the different types of users, both the internal users and the external users. The internal users includes the management, the board of directors, or the owners, the shareholders or stockholders, and even the employees. External users includes, the example for this are the creditors, investors, lenders, and so on. and thereby this and the end product of the financial and the end product of the accounting process will be
Now, what is the difference between bookkeeping and accounting? So bookkeeping, it involves only the recording of the business transactions, while accounting, it involves the process of bookkeeping. Bookkeeping is only part of accounting, while in accounting involves analysis, influencing, problems solving, and decision making. So accounting is much broader compared to bookkeeping because bookkeeping is only part of accounting. So that's how it is. Now, in accounting, we will encounter different assumptions, and we follow these assumptions. So what are these assumptions? The first assumption is what we call going concern. It assumes that organization will continue to operate in the future. The second assumption is what we call monetary unit. Only transaction data can be expressed in terms of money is included in the business transaction. The third assumption is what we call economic entity, and it states that it includes any organization as a separate entity or unit in the society. Okay, let's go to the business entities. Now, there are different types of business entity or business organizations. And there are three major business organizations here in the Philippines. So we will talk about that. So the first one is the sole proprietorship. So from the word itself, sole proprietorship, meaning the business is owned by one owner. Okay? It is considered to be the easiest and simplest type of business organization. And it has one owner. So therefore, there is no conflict between other owners because he is the only one. Sole proprietorship requires the smallest amount of capital to start up. The next type of business organization is what we call the partnership. So partnership is created by 2 or more individuals but not more than 5. So in partnership, there is limited lifespan of the business. Same with the sole proprietorship. Now the advantage of having partnership is that they can raise more capital because there are 2 or more individuals. And then I think the disadvantage of partnership is in terms of decision making, they have to consult their partners before deciding on certain decision. So the next type of business organization is what we have, the corporation. So corporation are created by 5 or more individuals. It is said that the corporation is the most complex type of business organization. It requires bigger capital, and the business is managed by the board of directors and headed by the chairman, which is the highest position in the BOD. So in corporation, the ownership can be transferred, and this is considered to be an advantage of a business entity. Transferable, and also the lifespan of the business or the corporation is unlimited. Now let's go to the basic accounting equation. So in accounting, we will have only one major accounting equation, and this is assets equals liabilities plus owner's equity. So what are the accounts under the assets section? Okay, so before that, let me tell you that the assets are divided into two sections. First section is for the short-term assets, which is with short-term, it is within the normal operating cycle of the business, and that is what we call the current assets. On the other hand, the opposite, which is the long-term assets, it is called the non-current assets. So let's talk about first the current assets. So these are the example of current assets. We have cash or cash in bank, cash on hand. Then we also have petty cash fund. We also have accounts receivable. We have cash equivalents, notes receivable, accrued income, inventories, prepaid expenses, and unused supplies. So these are the current assets and not limited. These are just an example of the current assets, but not limited up to this. Okay, so we also have what we call contra asset accounts. So a contra asset account is considered to be a deduction on the main asset account. We have the estimated uncollectible accounts. Of course, if you have the accounts receivable, this is the amount that you will collect in the future, but there are debtors who won't be able to pay you. So those people who will not be able to pay the business will be estimated, and this is under the estimated uncollectible accounts. Now let's go to the non-current assets account. Okay, first we have the property, plant, and equipment, land, building, equipment, and fixtures and furnitures. And we also have our contra asset accounts for the main asset account. So buildings, equipments, those are tangible assets of which the values depreciate, meaning its value reduces as time goes by. So there is what we call the accumulated depreciation. Okay, so accumulated depreciation, this is for repairs and maintenance. So that's it. Now let's go to the liabilities section. Now the same with the assets, the liability section is also divided into two. And what are these? These are the current assets and non-current assets. So under current accounts, these are liabilities which is payable within 1 year or within the normal cycle of the business operation. So what are these accounts under the current assets accounts? We have, so what are the accounts under current liabilities? So we have accounts payable, notes payable, accrued expense, and earned income. And under the non-current liability section, we have notes payable, which is payable more than 1 year. And another one is mortgage payable. So let's go to the owner's equity section. Now, owner's equity means, or it represents the claim of the owner against the capital, against the assets of the business. So owner's equity, you can get the amount of the owner's equity by deducting the liabilities by deducting the liabilities to the assets. Okay, so that is owner's equity equals assets minus liabilities. Now, there are 4 subdivisions of owner's equity. What are these? First is the capital. Second is the drawing. Third is the revenue. And lastly is the expenses. So now we will tackle about the financial statements. Now again, financial statements are the end product of the accounting process or accounting cycle. And this is considered to be what we use to analyze the performance of the business, whether it is gaining, it is profitable, or it is not performing that well. This is one of the reasons why accounting is called the language of the business. Because through this financial data, the business users, or the users, both the internal and external users, can assess whether they have to invest on the business or they have to further their stay at the business. And these are also used for taxing reasons. After the business transactions are identified and recorded and summarized, the 4 financial statements are prepared and summarized. So these are the 4 financial statements that we will encounter and we will create. First is the statement of comprehensive income, or this is also known as income statement. So in the income statement, it will show the reader or the users the amount of income that the business has earned. Second financial statement is what we call the statement in financial position or the balance sheet. So in the balance sheet, you can see there the amount of assets, the liabilities of the business, and the owner's equity of the business. The third one is the statement of changes in owner's equity. And the last one is the statement of cash flows. So take note that all of these financial statements has to be created because these are interrelated to one another. So let's say, for example, in an income statement. So in the income statement, it shows the income of the business. And that amount of the income of the business will be shown also in the statement of financial position. So that amount of income will be used to compute the owner's equity section. So they are all interrelated. Okay, this is another time to have an activity. So the next activity that we will have, I will show you a graph. Okay, so this is the graph. The table. So this is the table. So what you're going to do is you have to identify the accounts listed from 1 to 10, and you have to identify whether it falls under assets, liabilities, or owner's equity. So very easy. I know you can do it. So let's go. For simple purposes, I will give you an example. Okay, so rent expense. So rent expense is under, it is under the owner's equity account. Okay, remember the 4 subdivisions of the owner's equity. We have the capital. Second, we have the revenue. Third, we have the drawings or withdrawals. Then the fourth one is the expenses. Okay, So rent expense falls under the owner's equity. Okay, I will give you time to answer all of those questions. I will give you 5 minutes for that. Okay, time is up. We will check your answers. So for number 1, cash in bank. Okay, it falls under assets. Yunwo capital. Okay, capital. So it is under the owner's equity. Accounts receivable. Okay, accounts receivable fall under asset section. Asset accounts. Next, number 4, accounts payable. Okay, accounts payable is liabilities. Taxes and licenses. These are expenses. Suzy drawings. Okay, this is under owner's equity. Very good. Number 7, notes payable. Okay, since it's an obligation, it's payable, so that falls under, okay, liabilities. Number 8, commission income. Income, so it falls under owner's equity, of course. Number 9, we have land. Land, that's asset, of course. Last one, prepaid expense. Okay, this may sound confusing because it has the word expense. Okay, so the answer is assets. Although it has an expense account, but prepaid expense, these are expenses which is not yet incurred but is already paid. So, meaning the business paid in advance for that liability. Okay? So, how nice? Okay?